Welcome to Corporate Finance Unleashed, where we simplify financial concepts for smarter decision-making. Today, we're going to briefly introduce three core financial statements that every publicly traded business uses: the balance sheet, the income statement, and the cash flow statement. Understanding these statements is crucial for analyzing a company's financial health and making informed investment decisions. The balance sheet is a snapshot of a company's financial position at a specific point in time. It shows what the company owns, what it owes, and the equity invested by shareholders. Assets are what the company owns, like cash, inventory, and property. Assets are usually listed in order of liquidity, meaning how easily they can be converted into cash. Liabilities are what the company owes to others: debts, loans, or accounts payable. These are obligations the company needs to fulfill. Equity is the shareholders, also known as the owners, stake in the company. It's essentially what's left over after subtracting liabilities from assets. If a company has $1 million in assets and $400,000 in liabilities, then the equity or net worth of the company is $600,000. This is represented by the fundamental equation: assets equal liabilities plus equity. Next up is the income statement, also known as the profit and loss or P&L statement. The income statement shows a company's performance over a period of time, detailing revenue, expenses, and profits. Revenue, or sales, is the income a company earns from selling goods or services. It's the top line of the income statement. Expenses are the costs of running the business, including things like salaries, rent, and utilities. This can also include cost of goods sold, which are the direct costs associated with producing the products sold. After subtracting all expenses from revenue, you're left with net income or profit. This is the company's bottom line and tells us if the business is profitable. If a company has $500,000 in revenue and $400,000 in expenses, its net income is $100,000. This net income figure is key for understanding profitability and is often used to calculate metrics like earnings per share. Finally, there's the cash flow statement. This statement tracks the cash entering and leaving the company, giving us a clear view of its liquidity. Cash flows are divided into three major categories to display from where money is flowing in or out of the business. From operations explains cash generated or used in core business activities. It includes cash from sales, minus cash paid for expenses. Positive operating cash flow indicates a healthy business. From investing covers investments in assets, like purchasing equipment or property. Cash used here signals growth, while cash earned might come from selling assets. From financing reflects cash flow related to raising capital, such as issuing debt or equity or repaying loans. Positive financing cash flow means the company is raising funds, while negative means it's paying down debt or distributing dividends. If a company has positive cash flow from operations but negative cash flow from investing, it might be expanding by buying new assets, which could be a positive growth signal. These three statements work together to give us a complete picture of a company's financial health. The balance sheet shows what a company owns and owes. The income statement shows its profitability, and the cash flow statement reveals its cash position. Imagine a company with strong revenue on its income statement, but a weak cash flow from operations. This could indicate that while the company is making sales, it's having trouble collecting payments or controlling expenses. That's a quick overview of financial statements. Understanding these statements is key to making informed investment decisions and assessing a company's financial health. If you found this helpful, make sure to like, subscribe, and hit the notification bell for more finance insights. Have questions about financial statements? Drop them in the comments. Here's to your mastery of the money game.